Hey, everybody. Welcome to the International Tax Lunch. I'm Phil Hodgen, and today is September 11, 2020. We do this on the second Friday of every month at noon Pacific time, and you listen online through CalCPA, which is what you're doing right now. And thanks, Melissa, for driving the bus today. Or you can watch the show later when we upload it to YouTube. The topic this month is about Section 962. And Section 962 was an obscure little backwater of the Internal Revenue Code until our friends in late 2017 dropped the corporate tax rate to 21%. And at that point, it became extremely interesting to Americans who are shareholders in foreign corporations. And so I'm going to talk about this today and talk about what problems it solves, how it solves it, and give you sort of a broad overview of the Section 962 game. The idea basically is that humans can get taxed as if they're corporations for some purposes. Anyway, that is it. I'm going to hold the questions until the end because I suspect we're going to use up the whole time. My email address is on the final slide, and so if there's a question that we don't get to for some reason, like I use up all the time, just ping me an email and I'll do the best I can to solve the problem for you. Anyway, let's launch. Here's our table of contents, and there's a little clue here. Thing 1, Thing 2, Thing 3, Thing 4. The Section 962 election toggles a different tax result under 4 different code sections. It creates less inclusion of gross income, and that's Section 250. It creates a lower tax rate. It invokes Section 11, the corporate income tax rate section, rather than Section 1, the human tax rate section. Thing 3, it allows human beings to take the indirect foreign tax credit permitted by Section 960. And Thing 4, the Section 962 obliterates the entirely fabulous Section 959, which says all dividends from CFCs are tax-free, and instead substitutes a new rule in there saying some of the dividends are going to be indeed taxable. So those are the 4 things we're going to talk about today. And I should start my timer so I know when I run out of time. All right, let's talk about the introduction. We're going to start way back and sort of say, put the Section 962 election in context. First things first, this is the type of person that we're going to solve the problem for today. You've got a generic U.S. citizen. I'm arbitrarily saying that our U.S. citizen is living abroad, running a generic kind of bricks and mortar kind of business, nothing fancy. Could be anything from a little manufacturing plant to a dry cleaning store or anything. Just running it through a corporation like every other business in that country where our U.S. citizens living. The same principles are going to apply if you have a U.S. citizen living in the United States, except you'll see when we come down to the direct foreign tax credit at the very end for dividend payments. Obviously, if you're not living abroad and you're not paying full tax on dividends received, there's not going to be quite as much there. There may be some because there'll be withholding at source in all probability, but there won't be as much. So anyway, so that's it. For your purposes, just think of it, U.S. human being, 100% owner of a foreign corporation, and real operating business, no fancy schmancy stuff. So let's step back and say, well, if Section 962 is so fabulous and it's going to cure every disease we have, what exactly is the disease? And here's the problem. You have a foreign corporation and it earns money. It makes a net profit at the end of the year. And wherever that corporation exists, it's going to pay corporate income tax in that country. And then because of Internal Revenue Code sections 951, which is Subpart F income, or 951 Cap A, which is global intangible low taxed income, the shareholder is going to have imputed gross income and pay individual income tax on that. And the big problem you face here is that you've got double taxation of the same blob of net profits, corporate level in a foreign country, individual level in the United States, and there's no ability to take the foreign tax credit just by default by the individual. And so you end up with a double taxation problem. And if you want to dig even deeper, why is this disease? Why does it exist? It's because the United States has citizenship-based taxation. Like every other civilized country, if we just made the rule that you leave the United States, you don't pay tax until you come back, none of this would be necessary. But I'm not to gripe today, because today is not a griping day. The Section 962 election changes four things. And you can see in the column on the left, this is the default treatment of a CFC shareholder, which is what we have. We have an American who owns 100% of the stock of a foreign corporation. Therefore, it's a controlled foreign corporation. And you can see the default treatment of that corporation and the shareholder on the left column. And on the right, you can see the changes that are made by making the Section 962 election. Um, and we'll go through these in detail, but I just want to show you at a high level. There's less taxable income of a certain category, the global intangible low taxed income. The tax rate on the included income in the individual's gross income is going to be lower, 21% in the case of the Section 962 election. The person making the Section 962 election will be allowed to take the indirect foreign tax credit under Section 960. Ordinarily, that's only reserved for corporations, but individuals are allowed to do it and claim the indirect foreign tax credit if they make the 962 election, meaning that a U.S. shareholder, the human being, can pretend that he or she actually paid the corporate income tax that the foreign corporation in real life paid. And finally, the bottom. So we see three green things. That's good as a result of the Section 962 election. And the bottom, how are dividends taxed? Well, in the default mechanism, dividends aren't taxed at all. But in the Section 962 election context, dividends are taxed according to a semi-messy little formula that we'll go into later. So those are the results. And if you look at the result, this all came into being in 1962 in the Stone Ages. And what Congress was trying to do when they introduced the Subpart F rules in 1962 was trying to give a situation where an individual shareholder would be indifferent as to whether he or she is operating a foreign business through a foreign corporation or operating a foreign business through a branch operation of a domestic corporation. So if you look at each of those four items, you say, yeah, that sort of behaves like a default Delaware C corporation. Income inclusion, Subpart F, well, that'd be like rents and dividends and passive income. That would just drop onto the Form 1120 as income. The Section 951 Cap A income at 50% for other reasons than Section 951 Cap A, that income would only be taxed at 50%. Side note, this is Section 250, and we're not going to play acronym soup today, but there's a thing called FDII. When a domestic corporation has foreign income, they're entitled to a 50% deduction, and that's why it would work. 21%, your Delaware C corporation would pay that. The Delaware C corporation would be allowed to take an indirect foreign tax credit for any taxes paid in the other country on the branch operations. And the shareholder would indeed pay income tax on dividends if the dividends were distributed from the Delaware C corporation to the shareholder. So that's the rough template of what the government was trying to do. But, as usual in the tax code, whenever they sort of do this monkey business, BS, let's pretend stuff, sometimes when the pieces bolt together, they don't bolt together all that well, let's just say. So you sort of have to deal with a few mismatches now and then, but it works approximately correctly. Now, there are some alternatives if you don't want to use the Section 962 election. And so think of it this way. A U.S. shareholder has this pass-through income, Subpart F income, or global intangible low-taxed income, if three things are true. Number one, the corporation is a controlled foreign corporation. Number two, the shareholder is a quotes U.S. shareholder, close quotes, and that's a defined term. And number three, that foreign corporation has certain bad types of income, namely Subpart F income, 951 open parentheses A, or global intangible low taxed income. That's Internal Revenue Code section 951 cap A, open parentheses, little a, close parentheses. So if you defeat any one of those three things, hey presto, you don't have this pass-through income problem and the potential for double taxation. So what do? Top bullet point, use pass-through entities instead of C corporations. You don't have a controlled foreign corporation. You've defeated one of the three. The second one, again, you want to have not a controlled foreign corporation, so you decide you must have a foreign corporation for some purpose in the other country, but you reconfigure it so it's not a controlled foreign corporation. So typically that means U.S. shareholders own up to 50%, but no more. So you change share ownership. Third one is, we toggle this requirement that the shareholder is a quotes U.S. shareholder, close quotes, and that means that someone owns 10% or more of the stock. So you fix that. Now, if you don't want to tinker with the structure of the entity and the ownership and all of that, then you look and see if you can tinker with the type of income. And there's this thing called the high tax exception, which says that if your Subpart F income or if your global intangible low taxed income is taxed at a high enough tax rate in the other country, then there's no pass through, and this foreign corporation basically behaves like a default subchapter C corporation, as you would expect it to, with no sort of force through of income to the shareholder. So if you have that, and this is the high tax exception works if 90% of the U.S. tax rate, so 90% of 21%, whatever. So that's what, 18.9 or whatever. I don't know. Anyway, so you pay high enough tax, you don't have a problem. And then the final alternative solution is, God in Congress perceives you, the little mini multinational, as if you're just like Apple and Google and General Motors, and you have all of the bandwidth and budget for high quality tax help. You got a whole floor in a high rise full of people in cubicles doing nothing but international tax work, and you use a parent subsidiary structure. And that's the way kind of the code is set up. They anticipate that the U.S. parent company, C corporation, will own a foreign subsidiary, and the code is built that way to flow everything through ultimately to the U.S. shareholder. Most of the time I find in real life this is not useful, because if you have a generic U.S. citizen living in Canada, for instance, and running a regular kind of business, for Canadian purposes, it's not really beneficial to bolt a Delaware corporation on top as a holding company. Now you're creating a giant mess in Canada. So the parent subsidiary structure will sometimes work, but more often, my experience is, for practical reasons, you won't use it. But anyway, so that's the way you think about stuff that you would like to do to solve a tax problem for your person instead of Section 962. So let's start moving through here. Thing 1 and thing 2 are the easy ones. Thing 3 and thing 4 are the more difficult ones. So let's start with the easy stuff. Less income. This is the Section 250 deduction. So just again, to remember what happens, you have a foreign corporation, and it's a controlled foreign corporation, and sections 951 and 951 cap A force the inclusion of the corporate net income into the gross income of the shareholder. So we've got that 100% push up, but let's see if we can create a deduction. And indeed we can, because Section 250 exists. The way it works, just to give you a sense of what the tax return looks like, and this is for Subpart F because this is the simpler one. You start with the Form 5471 Schedule I for the controlled foreign corporation. The inclusion runs over to Schedule 1 attached to Form 1040, bubbles over to the front page of the 1040 in gross income. It works its way down. You subtract anything you need to to, like the standard deduction. To come to taxable income, you compute the tax, and then you have the tax on 12A. So pretty simple. And you can see that this means that Subpart F income gets taxed as ordinary income. So whatever the marginal tax rate is for the taxpayer, it is what it is. Again, Section 951 Cap A income, the global intangible low taxed income. It's a little bit more complicated, but the same idea holds true. 100% of the income from 5471, this is Schedule I-1, will flow through Form 8992 because this is where the computation of the inclusion amount happens, and then onto the tax return through Schedule 1 and then page 1, and then on eventually to the tax liability. So again, a little bit more complicated, but 100% of the income flows through and gets taxed at ordinary rates. But with the Section 962 election, we introduced the ability to take the Section 250 deduction. So I've repeated the flow diagram from the previous slide at the top so you can compare what's happening. The lower diagram from left to right, we start again with the income inclusion amounts that start at Schedule I-1 of Form 5471, go over to Form 8992, and you compute the inclusion amount. And then you take a little detour onto Form 8993, which basically takes your total inclusion amount, multiplies by 50%, and says, hey, presto, you've got this deduction. So you take 100% of the income from Form 8992 and 50% of the income as a deduction on Form 8993, and you port both of those over to some work papers that you're going to have to do if you're doing a Section 962 tax return for an individual. And what I use for work papers is I just run a dummy Form 1120 on Lacert, and it does all the math for me, and it computes everything I need to do. And so that's what I mean by work papers. And you don't attach the dummy Form 1120 to the Form 1040 as your statement. There's a separate statement you have to do, but I'm not going to talk about the nitty-gritty of that statement today. Anyway, and then you take from the work papers, you just take the bottom line tax liability and drop it on to the Form 1040. So this is how taxable income is reduced by 50%. So let's look at, and now that was thing one, pretty simple, just an arbitrary 50% deduction. It's one of these, the Lord giveth, the Lord taketh away. So sooner or later, Congress is going to take that away because this is what they do to deductions. Thing two, lower tax rate. This is the big selling point, and everybody looks at this first. Frankly, I think it's less important than the final two things we're going to talk about, but it's the one that is all shiny and it attracts everybody's attention at first. And basically it says, look, you don't have to pay tax on this gross income inclusion at ordinary rates up to 37%. Instead, use corporate rates. Hey, look at this, it's 21%. That's magic. And here's the language straight out of Section 962. It just says, pretend that the amounts included under Section 951, open parentheses A, the Subpart F income, will be an amount equal to the amount that would be imposed under Section 11 if you pretend you're a domestic corporation. And for reasons I'm not going to get into now, but it's in Section 951 Cap A F, I believe. You treat the global intangible low taxed income pass through in the same manner, and the Section 11 rule applies as well. So those are the simple ones, just an arbitrary change in the tax rate and an arbitrary change in the amount of taxable income. So let's look at the two of them together and see what the impact is. And you look at this and say, ooh, shiny. So let's look at the Section 962 election and no Section 962 election. So first, let's look at without, just the default methodology if you didn't make the election. You got a sample tax return along with these slides, and these numbers are from the sample tax return. Well, actually, the numbers on the right with the election. The numbers on the left, I hold those in my hip pocket, but I did a sample tax return to calculate those. 951 Cap A, gross income inclusion, 600,000. That's our consistent assumption, which means that this is how much drops onto Form 1040. I'm going to arbitrarily assume the standard deduction for this person. So taxable income is 587,800. Average tax rate 31%. Trust me, I know because of the diagnostics page that Lacert burped out. And the total tax liability, $182,474 without the Section 962 election. On the right-hand column with the election, look at the impact of the Section 250 deduction. We start again with gross income of 600,000, but we take the $300,000 deduction because of Section 250. And so the net income inclusion is 300,000, which is going to be our taxable income. And now we're going to multiply it by 21%, which is a handy dandy $63,000 of income tax liability. So $119,474 tax savings on this global intangible low taxed income inclusion just by making the Section 962 deduction. So this is really good. I like understatements. All right, now we've done the easy parts. Now let's move on to the harder ones, which are the indirect foreign tax credit. And then thing four is, what do we do about dividends? So the baseline rule of indirect foreign tax credits is that if you are a human, so sad, too bad. This is Section 960, which allows the indirect foreign tax credit, and it's reserved only to corporations. And if you look at Section 901, which is the foreign tax credit rule, it says, you, dear human taxpayer, or any taxpayer indeed, are allowed to take a foreign tax credit for taxes actually paid by you, aka direct foreign tax credit, or any taxes deemed paid by you because of Section 960. Well, without the Section 962 election, it can take neither, right? Because the controlled foreign corporation paid a bunch of tax. Did the human at the top pay the tax? No, the foreign corporation did. So direct foreign tax credit is out. Can't take it because of Section 901. Can we take the indirect foreign tax credit? Well, if Section 960 says so, and Section 960 says only domestic corporations can take the foreign tax credit, so we can't take the indirect foreign tax credit. So that's two strikes and you're out, and no foreign tax credit. But what we want is we want a foreign tax credit because we don't like double taxation. And here are the words that just went along with what I said in front of that little diagram I gave you. Citations and everything. Lucky you. There are two limitations that you have to think about on how much the tax credit allowable is. So we're going to now assume you're making the Section 962 election, and the question is, how much tax credit can you take? So if you remember, the basic concept of the foreign tax credit is there's a limitation, and this is Section 904 of the code, and it says the most foreign tax credit you can take is either what you paid on that income for U.S. tax purposes or what you paid in real life to the foreign country. And you never take more than the amount that you paid to the U.S. on that same income. So that's the Section 904 deduction, which limits you to the amount of actual tax paid on that income item. So for global intangible low taxed income, there are actually two limitations on how much tax credit you can claim. And this is all baked into the Form 1118. And so this is another good reason to use a dummy tax return in Lacert or your favorite tax return prep software just to do all the hard work for you on Form 1118. But you start with the idea that 100% tax is your starting point. So foreign corporation pays $100 of tax. And then Section 960D says, hey, just for global intangible low taxed income, we're only going to allow you to take an 80% deemed paid tax credit. So you take a 20% haircut off the top. Then you take that 960 open parentheses D limited amount, and you go over to section 904 and you do the regular stuff where you compare the amount deemed paid to the foreign country against the actual tax liability in the United States, and you end up with the tax credit allowed in the US. Subpart F income, you don't have that special thing built into section 960D. The only limitation you have is the maximum credit allowed is the tax paid, the tax liability computed for US tax purposes. So and the sequence is important, obviously, for global intangible low taxed income. The weird thing, we use a Form 1118. So the corporate foreign tax credit rule form is bolted to your individual income tax return that you're preparing. And that's how you calculate the foreign tax credit allowable. And you tell the IRS how much it is. And then from there, it goes to the correct schedule. What's that? Schedule 2, I think. And then from there on to the Form 1040. So just from the sample tax return that I gave you, this is where you're going to find the credit for taxes paid. This is the 904 limitation amount on Part 3, Line 1, Schedule B. So this is what you're going to port over, and that's going to be your limit. Oh, it goes to Schedule 3. Anybody else want to go back to the world when they didn't have Schedule 1, 2, 3 attached to Form 1040? I do. Now, so that this tells you in a general sense how you can take the foreign tax credit for corporate income tax paid by the controlled foreign corporation, but you can take that tax credit on the individual return. Now, in order to do this right and make the math work out properly, there's a gross up amount. And so the numbers you can see on the sample tax return, I assumed that there was going to be $600,000 of income at the corporate level, and the corporation is going to pay $120,000 of tax. So it shows a cash or earnings and profits in the corporation after payment of foreign corporate income tax of $480,000. Well, if you pass through that $480,000 as global intangible low taxed income, which is the way Form 8992 will do the math for you, then the individual U.S. shareholder kind of got the best of both possible worlds. Reduced taxable income, got a deduction, and the foreign tax credit. So government doesn't like to give you two things at once, so we gross up the income again, and we gross it up because of Section 78, and that says whatever the tax was paid by the foreign corporation, treat that as a deemed dividend to the shareholder, and that way we'll gross up the income to the correct amount, and now you can take the foreign tax credit. In a very simplistic way, here is how you derive the numbers and where they come from and how everything flows onto the Form 1040. Again, we're looking at Form 1118 to calculate all of these things for the results at the corporate level for the controlled foreign corporation. We already went through, you find the foreign tax credit number and you drop it onto Form 1040 Schedule 3, and then it drops onto Form 1040, and that's your tax credit. But the Section 78 dividend is going to go into the work papers. It's going to go into that dummy Form 1120 that I do it that way because it's easier. And specifically, it'll go into Schedule C, and that way it'll add back into the corporate income that you're calculating. So you can calculate the true tax under Section 962. And here's what an excerpt, this is sort of the bottom half of Schedule C attached to a Form 1120. And you can see on line 17, we started with $600,000 of income, paid $120,000 of tax, which means that Form 8992 gave you $480,000 of global intangible low taxed income. And we had $120,000 of tax, and line 18 shows you where we gross up income again, and you drop down to line 23. The total for that column says, here's your total income, $600,000 again. And for what it's worth, just referencing back to the Section 250 deduction, you can see how the Section 250 deduction works in real life on the work papers to reduce taxable income for at the computed under corporate theory from 600,000 to 300,000, because you're going to take that line 24 and port it over to page 1 of the Form 1120. So the Section 78 dividend, this is just where you're going to find it on the Form 1118. Just side note, if you look at Part 2 and column 4, the bottom right-hand corner of this slide, you can see the 96,000. Just for kicks and giggles, that's the 80% limitation. So 120,000 of tax was paid. This 96,000 is going to be the deemed limited number under Section 960, open parentheses, D, close parentheses, that's then going to be dropped into the cauldron and bubble, toil, and trouble for Section 904 limitations on the allowable foreign tax credit. And here's where everything comes together. This is the very high level result, and it shows how double taxation is eliminated because you're allowed to take the indirect foreign tax credit. So again, we're starting with the idea that this controlled foreign corporation had 600,000 net income, paid 120,000 of foreign corporate income tax. Remember, we sent that income through to the individual. We used the Section 11 calculations, which allowed us to reduce income by half and then apply 21% tax rate, which means $63,000 because that's 21% of $300,000 of taxable income. And because of the Section 904 limitation, the taxpayer gets the lower of actual tax liability, 63,000, or 80% of actual tax paid, which is 96,000. So you can see that the 951 Cap A income exclusion, the tax liability on that is exactly set off by the tax credit allowed, which means the only tax imposed on the corporation's net profits will be the foreign corporation income tax paid in the foreign country as God intended. So this, to my mind, this is the critical element that you're shooting for when you're making the Section 962 election. This can make all the difference in the world to the effective tax rate worldwide for an American shareholder in a controlled foreign corporation. So this is what to focus on. Don't focus on the Section 11. Oh, look, 21%. Don't focus on Section 250. Oh, look, only 50% of income is taxable. Because, I mean, any tax liability up to 96,000 would have been completely offset by the foreign tax credit. So it really doesn't matter whether the tax rate was 21% or 25% at the corporate level. Anyway, so there you go. Focus on this more than anything. And when you're doing what ifs for your clients, really focus on your ability to take the indirect foreign tax credit. All right. Let's now move on to dividends. Dividends are the fourth thing that the Section 962 election changes. And unlike the first three, where the changes were in favor of the taxpayer's wallet, this one works the other way. It sucks money out of the taxpayer's wallet. So this is going to be one that you're going to be watching carefully to see how much it offsets the benefits you received from things 1, 2, and 3. Here's the basic idea of the Section 962 election and its impact on dividends from the controlled foreign corporation. Section 959 is the default rule, and Section 959 says, when a U.S. shareholder receives a distribution of previously taxed earnings and profits, that distribution is not included in gross income. Translation means you pay your income tax on the Subpart F inclusion or the global intangible low tax income inclusion, and you do not pay a second tax when cash is distributed out to the corporation to you, the shareholder, which is good. We like one level of tax. We don't like two levels of tax. Unfortunately, Section 962 throws that rule overboard and substitutes something else that says, hey, guess what? Some of that distribution you're receiving will indeed be dividend income to you, and you will have to pay tax. So good luck, you're back in the double taxation zone. And this is not surprising because remember what I said, that the original plan in Congress in 1962 was to create a rule that says an individual U.S. shareholder should be in approximately the same position operating a foreign business through a foreign corporation or operating a foreign business as a branch of a domestic corporation. And if you had a domestic corporation, when dividends come out of your favorite Delaware C corporation, the shareholder is going to pay tax. So, not unexpected, not pleasant, but it's working as desired by Congress. So let's go through this. This is a lot more moving parts than the previous ones. First, let's talk about our favorite little gratuitous tax, the 3.8% net investment income tax. The important thing to remember for net investment income tax is it stands in its own little chapter of the Internal Revenue Code, quite apart from the income tax rules. So whatever income tax rules you think apply have no impact. Your magic has no power here, right? So for net investment income tax, we start from ground zero to determine what is the taxable income and then apply the tax rate to it. So the first thing we look at is that. So what is a dividend? Well, a dividend for net investment income definitions is a distribution from earnings and profits of a corporation. And for net investment income, that definition of that type of income, it does not matter whether the distribution came from previously taxed earnings and profits or previously untaxed earnings and profits. It's all dividends. So what this means is anytime there is a distribution from a controlled foreign corporation to a shareholder, an individual shareholder, the 3.8% net investment income tax is going to apply. And this is true whether it's for someone who made the Section 962 election or did not. So here's a little flow chart that kind of shows you all the moving parts that we're going to be talking about in this section. And on the right in the dashed box, the blue dashes around it, shows you what happens when you've got a dividend received. We put 100% of that into the net investment income tax box on Form 8960, do the calculations, and then drop the net tax liability onto Form 1040. So here you can see just an excerpt. This is, again, an excerpt from the sample tax return that I gave you. 480,000. The assumption I made here was $600,000 of taxable income at the corporate level, paid tax of 120,000, and then distributed 100% of the excess cash in the corporation, 480,000, as a dividend, all in 1 year. So that's why we have a $480,000 dividend. You do the math on lines 13, 14, 15, 16, and then calculate the tax on line 17. And that goes over to the Form 1040. So relatively simple, a little hidden thing, but you can see it's money, unavoidable, so you don't cry too much. Because there's nothing you can do about it, right? And that's what Epictetus told us to do. Don't worry about stuff that you can't do anything about. All right, section 4.2. So now we're talking about, we've dealt with net investment income tax, submit and be assimilated, pay the tax. Now let's talk about income tax on this $480,000 dividend that's coming out of the corporation. And again, we're assuming that the individual taxpayer made the Section 962 election, so we're trying to figure out how much of that $480,000 distribution is included in gross income. And along the way, we'll decide whether this is ordinary income or a qualified dividend. So here is where the Internal Revenue Code throws Section 959 overboard into the murky deeps. Says Section 959A1, this is the one that says distributions of previously taxed earnings and profits aren't included in gross income, says, nah, ignore that and include gross income, to the extent that earnings and profits distributed exceed blah, blah, blah. So there's a math problem after this, but the important thing to note from this slide is the old rule that you're familiar with does not apply. So now we have to do some extra work to figure out what the new rule says. And the new rule is in Section 962D and the companion regulations. So again, we're going to start with our same little flow chart. And we're starting at the top where we've got our dividend received, and we're trying to compute how much of that dividend should we exclude from gross income and how much of that dividend should we include in gross income. Because Section 962, in the way it phrases the formula for the math problem, anticipates that some of the distribution will be excluded from gross income, which we like. The first thing we have to do is figure out the Controlled Foreign Corporations quotes Section 962 earnings and profits, close quotes. And this is the same as regular corporate earnings and profits. It's just earnings and profits that are accrued during a year in which the Section 962 election is made. So in the little simple example that we have, that we're working on right now in our heads in the sample tax return that you have beside you, we're assuming that all $600,000 of net profit at the corporate level was earned in a year that the shareholder made the Section 962 election. So we're starting from our Section 962 earnings and profits calculations with a starting point of $600,000. And then we're going to do stuff to it. So we need to calculate how much of the distribution, which is going to be 480,000, right? Because they only have they paid 120,000 in foreign corporate tax and they have 480,000 of cash left over. How much of that 480 is going to be taxable? And the formula says, look at how much the distribution is, 480,000. Then compute this thing called excludable Section 962 earnings and profits, which translated means the federal income tax you, the shareholder, actually paid on the earnings and profits inclusions because of Section 951 Cap A and 951. And you subtract that, and whatever is left over is the taxable portion of the distribution. So pretty simple. Start from gross, subtract a number that you're told to compute, which is a function of tax paid, and the net after that is the taxable dividend. So let's look and see how it works. Tax-free distribution. So this is the excludable part. This is what we really want to maximize. And so let's understand really clearly how much the excludable amount of a dividend received when you make a 962 election, how much it's going to be. So I've bolded this stuff. It's a subtraction. So it says, starting from the phrase Section 959A1, it said, when such earnings and profits are distributed, you included in gross income to the extent that such earnings and profits, which means the amount distributed to you, exceed the amount of tax paid under this chapter, meaning the income tax chapter, on the amounts to which such election applied. So, and such election is the 962 election. So what you're looking for is you're looking and you're saying, oh, okay, I had some inclusions of Subpart F income. I had some inclusions of Section 951 Cap A, global intangible low taxed income. I paid some tax on my Form 1040. How much was that? That's the amount of subtraction that I'm going to take from the dividend I received, because that's not taxable, and whatever's left over is going to be taxable dividend to me. Now, here's where the baby Jesus wept part comes in. I've given you the citation here and a quote from the legislative history of the 1962 tax law change, in which this was originally introduced. This whole thing, Section 962, how you calculate all the stuff. If you read this carefully and you put on your super brainiac hat so you can understand how government bureaucrats write English, what it says is that the quotes tax paid, close quotes, is your actual tax payment in dollars to the Internal Revenue Service after foreign tax credit. And if you don't want to hurt your brain by reading that and trying to figure out what in the world they're saying, go look at the Form 1040 and lines 12A through line 18. And let's just look at it. My personal opinion is if I look at Section 962 and it says the excludable portion is the tax paid, and then I look at Form 1040 and I say, well, how much tax did I pay? Here's the math. You've got a tax liability computed on the pass-through income, whether it's Subpart F or global intangible low-taxed income. That goes on line 12A. Line 13B is going to be the allowable foreign tax credit to offset that tax liability on 12A. And then you rumble down a few more pages, a few more lines, forgive me, and you come to line 16, which is called total tax. So this is your tax liability. And remember our example where we had $63,000 of tax liability on line 12A, and we had a $63,000 foreign tax credit on line 13B because Section 960 allows that. That means that our line 16 total tax is zero. And now here's the critical part where I think, all you have to do is put on your midwit brain or even a dimwit brain. You don't have to read 1962 legislative history. And paid means paid. Lines 17 and 18, this is what the government calls payments. It's either a refundable credit, let's ignore that, or it's cash money, y'all, that you gave to the government. And if we use the example that I've given you so far, the cash money, y'all, that we paid to the government is zero. And so the tax paid amount is zero. That means the excludable amount of the distribution, the dividend that you received, is zero for calculating under Section 962D how much is included in gross income, therefore taxable as dividend income, and how much is excludable. The short summary of that is don't immediately think that if you have a computed tax liability on Subpart F income and a computed tax liability on global intangible low taxed income of X, you're going to automatically have X, that same dollar amount, as an excludable non-taxable dividend from the CFC to the shareholder. If there is any foreign tax credit that offsets that X number, that's going to reduce the excludable distribution amount all the way down to zero if that's how much foreign tax credit you got. So let's just walk through a simple example right here of what I mean, sort of taking all that abstract hand wavy stuff. You can't see me waving my hands because I'm not on camera. But let's just talk about it. So we start with gross income in the example of $600,000 that's included in the shareholder's gross income. Not in the gross, it's not included in gross income. We're trying to calculate how much cash distribution is made. We start 600,000 of cash in the business because it made 600,000 of profit, paid 120,000 of tax. E&P is 480. And cash is 480, and all the cash is distributed to the shareholder. So that's what's happening. And now we calculate the excludable portion of that 480,000 cash distribution. So we have the beginning part. We have income forgive me, there's yet another typo that I didn't catch. So in that column heading where it says section 951 open parentheses A, it should say section 951 cap A open parentheses A. And the reason is that 951 cap A is the global intangible low taxed income, and the section 250 deduction is allowable for it. Section 951A, which I have there by mistake, is Subpart F income, and there's no section 250 deduction. Oopsie. So we've got, run through the numbers. Start with $480,000 of inclusion. That's going to come off Form 8992, minus the section 250 deduction, $240,000, which is going to come off Form 8993. Taxable income we're going to calculate the tax liability on is $240,000. Next line down, U.S. income tax liability at 21%. This is for someone who made the Section 962 election. The tax paid calculation subtotal is $50,400. Now let's look at what actually tax paid means here for the purpose of calculating the excludable amount of the dividend. We know in real life that the foreign corporation paid $120,000 of foreign corporate income tax. And then down below that, the next line, $96,000 is the Section 960D limit. Remember that Section 960D says if you have global intangible low taxed income, you're only allowed to take a deemed foreign tax credit for 80% of whatever was actually paid by the corporation. And then finally, we come to the Section 904 limit, which is the lesser of that 80% number or the U.S. actual tax liability. And in our case, it's the actual tax liability. So it's going to be $50,400. What's our allowable foreign tax credit, Section 901? $54,400. A second typo. My apologies. This is bad. It should be 50,400. So they're going to offset each other. I got the bottom line right? But you can see that the actual tax paid is going to be zero. Therefore, the excludable section 962 earnings and profits is going to be zero. Therefore, the distribution of section 962 earnings and profits will be 100% taxable. And here's where you see it. 480,000 distributed, less excludable zero, amount of taxable section 962 earnings and profits, aka dividend income, 480,000. Just to be clear on this, the distribution from the controlled foreign corporation to the shareholder is treated as a legit distribution dividend from controlled foreign corporation to the shareholder. It doesn't go through the funny stuff of Section 962, where we pretend it was received by a domestic corporation in computing tax liability, because it doesn't say so. And there's a recent tax court case that says as much. It's a dividend, so that's the character of the income received. That 480 is going to be a dividend because it's a distribution of earnings and profits, and it's a qualified dividend if the CFC is a qualified foreign corporation. Otherwise, it's just going to be a dividend taxed at ordinary tax rates. And in the example I give you, I just assume it's going to be an ordinary dividend, ordinary income tax, not a qualified dividend. So as you work through this methodology here, what's going to happen to the dividend income, you can see we did that top level box that sort of looks like a little window. How much is the excludable part? Zero. How much is the includable part? All of it, 480,000. And so the 480,000 is going to go to Schedule B, like every other dividend. It's going to go onto the front page of Form 1040 as ordinary dividend income, and it's going to go into taxable income. And finally, you're going to compute the tax liability on it. So that's what Schedule B looks like. Nothing magic there. And there's where it's going to show up, and you can see how it's going to be included in gross income and therefore included in the calculation of income tax at the ordinary tax rates. I mean, by contrast, if you decided it was a qualified dividend, you would have put it in box 3A, and then computed the tax liability on the worksheet and then ported that number onto line 12A, just as the summary, as the conclusion of that worksheet. Next, we're going to say, all right, this is bad. So stepping back, without the Section 962 election, the entire $480,000 of cash distribution would come to the shareholder tax-free. With the Section 962 election, the $480,000 of cash distribution is included in gross income and is taxed. And so as you're trying to make the decision for yourself, if you're the business owner, or for a client, if you're a tax return preparer, you need to, frankly, just play with the math. You can either do it by building a spreadsheet or by just running up some quickie tax returns in your favorite software to see how it all balances out. And particularly the impact of the indirect foreign tax credit against the deemed income inclusions of Subpart F and global intangible low taxed income on the one side, and then all are partially offset by more income tax liability because you've got dividend income. So there's no easy answer, but you'll have to find out just by doing the numbers. But I'm going to give you an example now where I think that if you have a U.S. individual shareholder living in a foreign country that has a robust personal income tax system, tax rates roughly equivalent to U.S. tax rates, I think net, the 962 election is going to make a lot of sense. So this is going to be your default starting assumption if you have somebody living in a high tax country. And that is that, we have some extra dividend income, and there's some U.S. tax liability, but the individual shareholder is living in a country that also has foreign personal income tax rates roughly equivalent to U.S., paying income tax on that dividend income there, and taking a foreign tax credit here for foreign income tax paid there. And in theory, it should offset. And let's look at an example. So here's what we've got. In the previous section, we went through the numbers where we included the dividend income and gross income and calculated a tax liability that ended up as part of the number on line 12A. And now we're going to compute the allowable foreign tax credit on Form 1116, because remember, this is tax actually paid, directly paid by the shareholder. This is not the indirect foreign tax credit. So it goes on Form 1116. And we're going to show how this tax income, the foreign tax credit, offsets the tax on the dividend income. So here's my example, just a little excerpt from the Form 1116. And it's kind of weird that you've got an individual tax return that's got Form 1116 and Form 1118 attached to it, but it happens. You do the math, and you can just see at the bottom, you've got a bottom line allowable foreign tax credit of $138,924. And I'm not going to go through the math. I hope you all are more or less familiar with how the foreign tax credit limitations work. But that's where you get your number. Everything is going to go. This is, again, the excerpt from the scenario that you have a copy of. And so let's just sort of quickly look at what's happening. So line 12A, you've got $201,924 of individual income tax liability, of which $63,000 is the income tax liability computed on global intangible low taxed income that's passed through. And the rest of it is the income tax liability on the dividend received. Adds up to $201,924. Then look at line 13B. We have a number with the exact offset. So and again, that's because Form 1118 has a $63,000 allowed indirect foreign tax credit, and Form 1116 has the $138,924 allowable direct foreign tax credit. So matchy, line 12B, line 13B, line 14, Subtract, boom, boom. And we've got the line 14 is 0. And line 15 is the net investment income tax. And that's going to be the result of the Section 962 election in summary for the person who's operating a business abroad and living abroad. And so, except for the net investment income tax of 3.8% on the dividend income, everything works out really nicely for this U.S. shareholder living abroad. And so, this is why, just as a gut reaction, when I'm sitting down to work on these things, somebody's coming from any high tax country, I'm going to guess that the number is going to work out favorably for this person with the 962 election. And I also like the 962 election in that situation because it does nothing to the foreign tax situation, because it's purely a U.S. election that doesn't touch the structure, doesn't touch the ownership, doesn't make an impact on the foreign income tax liability at all. So the distributions, the conclusions. You're going to have additional income tax for the U.S. individual shareholder. The direct foreign tax credit is your Lord and Savior, so you hope that it's going to work. And if you don't have the direct foreign tax credit, meaning the U.S. company is operating in a country that has no tax on individuals, then I think the numbers are going to turn out badly for you. Well, there we go. We're almost at the end. Concluding remarks. Do the numbers. I mean, I think you're going to have to do Excel, or you're going to have a bunch of little sample tax returns that you're going to run what ifs in your software to do tax projections. Again, my hunch, the middle bullet point is highest tax rate countries, 962 elections make a lot of sense. Other situations, not necessarily, but you're not going to know until you know the numbers. With that, I'm going to wrap it up. We're about 59 minutes and 60 minutes, and there is no soul saved after 60 minutes, so we've got to do it. Thanks for listening. Email me questions. Next month, October 9, I'm going to be doing an hour about solving individual tax problems using income tax treaties. So a little bit of treaty stuff. Hope you enjoyed that. If you're not on our mailing list, go to hodgen.com/newsletters and sign up. If you already are, tell a friend, and I'll see you next month.